What if higher returns are not coming from better business, but from taking more risk? Look at this combination: returns going up, capital going down, leverage going up. This is not random. These three lines are connected. And the question is simple: what is really driving the improvement? When you look at this, the bank is clearly generating more profit on the same capital base. It goes from 3.29% to 4.58 in just 2 quarters. Think of it like this: the same machine is now producing more output. But here's the tension: is the machine more efficient or just running harder? Now shift your eyes here. The return on total assets barely moves from 0.23% to 0.27%. That's a very small change. So the assets themselves are not dramatically more profitable. If assets aren't improving much, where is the ROE expansion coming from? Here's where things get more nuanced. Margins expand strongly in fourth quarter, then compress in first quarter 2026. The business had a peak moment, then normalized. This doesn't look like a straight structural improvement. It looks more like volatility. So was fourth quarter strength sustainable or just a strong quarter? Now notice what's happening here. Earnings per share accelerate, especially into first quarter 2026. That's a sharp jump. But EPS can grow for different reasons: more profit, or fewer shares, or more leverage. So the number is clear. The driver behind it is still open. This is critical. The bank is heavily dependent on non interest revenue, around 75% to almost 80%. That means trading, fees, and market activity are doing the heavy lifting. Now think about that. If markets slow down, does this revenue mix hold? Here's where it gets very concrete. Market making grows from 25% to almost 32% of revenue. That's a meaningful shift. The bank is leaning more into trading activity, and trading is not stable income. So the question becomes, is this growth repeatable or cyclical? Now break the bank into pieces. GBM dominates, reaching up to 77% of revenue. Meanwhile, asset and wealth drops sharply in first quarter 2026, and platform even goes negative at one point. This is not a balanced engine. It's concentrated. So what happens if GBM slows? Look closely here. Provision goes negative in fourth quarter, then normalizes. That creates a temporary boost in earnings. It's like releasing reserves instead of building them. So earnings improved, but partly because risk cost disappeared. Now it's back. So which number reflects reality? Now focus. CET1 drops from 14.3% to 12.5%. That's a meaningful decline in capital buffer. The bank is operating with less cushion, and this is happening at the same time returns are rising. So is capital being used more efficiently or simply consumed? This ties everything together. Leverage jumps to 16.8 times. That means more assets per dollar of equity. At the same time, loan to deposit stays stable, so funding structure is not the driver. The change is coming from balance sheet expansion. More size on less capital. Now look at the spread. Interest income stays flat, but expense also stays high. There is no clear improvement here. So funding is not getting cheaper, which means margin expansion is not coming from funding efficiency. So where is it coming from? Now look at this. This is how much the bank spends to generate $1 of revenue. In third quarter, it spends about 62 cents. Then in fourth quarter, that jumps to more than 72 cents. And suddenly, in first quarter 2026, it drops back to around 60. That's a big swing. So think about what this means in practice. In fourth quarter, the business became heavier, more cost for less revenue. Then in first quarter 2026, revenue expands and the structure looks lighter again. But here's the tension. Did the bank actually become more efficient, or did revenue simply spike and make costs look smaller? Because notice, Expenses didn't fall, they increased. So the improvement is not coming from cost control, it's coming from revenue moving faster than cost. And that leads to a simple question. If revenue slows down, does this efficiency hold? Now look at this combination. Returns are going up, but at the same time, capital is going down and leverage is increasing. These three things are happening together, and that's not a detail, because returns can rise from efficiency or they can rise from structure. Here, the signals are mixed. The number improves, but the path behind it is changing. So before jumping to any conclusion, it's worth opening up this ROE and understanding what's actually inside it. Now look at this more closely. Here, we're not looking at ROE as a single number. We're opening it up. First block, the core engine. Return on assets barely moves, from 0.23% to 0.27%. That tells you the bank didn't really become more productive. It simply grew, with more weight. Now the second block, revenue. Notice how trading gains space. Market making becomes a bigger part of the mix. This starts to drive the outcome, but it also changes the nature of the revenue. It becomes more dependent on market activity. Third point, provision. In the middle, it turns negative. That lifts earnings in that period, but then it normalizes. So part of that improvement is not recurring. Now the fourth block, capital optimization. Leverage increases. Capital levels come down. So the bank is using more balance sheet per unit of capital. Less cushion, more exposure. And then you reach the end. ROE goes up, but it doesn't come from a single place. It's built from different layers, some structural, some not. So when you look at this whole picture, if you adjust the trading component or the level of leverage, which parts of this return would still hold and which wouldn't? Now bring everything together. Returns are going up, but when you look underneath, the core engine barely changed. What really expands is trading. And at the same time, leverage increases and capital comes down. So returns improve, but the structure behind them shifts. Now think about this in practical terms. Part of this result depends on market activity. Another part depends on how much balance sheet the bank is willing to use. And that creates two possible paths. In a strong market environment, this structure can accelerate returns. In a weaker environment, the same structure reacts in the opposite direction. So the question is not just the level of ROE, it's what is sustaining that number and how it behaves when the environment changes.